Hi, this is Mike Maloney with the final installment of our series on the In Gold We Trust report with Ronnie Stoperle. Ronnie, how are you doing?
Very well, Mike. Good to see you again.
Great seeing you. Okay, so this one starts with, is gold already too expensive? So give us your rundown on this section of your chart book that goes along with your In Gold We Trust report.
Well, the answer obviously is no. And if we have a look, for example, at the nominal gold prices in comparison to the inflation adjusted gold price, we can see that we would have to go to 2,300 US dollars to make a new inflation adjusted all-time high. Now, Mike, we know that those inflation numbers are now completely calculated differently compared to 1980. So actually, I think the real inflation adjusted price would have to be significantly higher from my point of view. But what is really important, Mike, for me is we write in the report that trust comes from repeatedly fulfilling expectations. And I think that gold did a tremendous job last year, like a reliable defender in your portfolio. And now, as we've said previously, nobody really cares about. But I think it's always prudent to buy an insurance when it's cheap and not when the house is on fire. So I think within this correction, we made the double bottom in March at 1680. Now I think that the consolidation is over. We're seeing that systematic buyers like CTAs, trend followers, they are returning. We're seeing that seasonality kicking in now. August is a great month. The whole third quarter shows very, very positive seasonal tailwinds. So in the last 20 years, Q3 was the best seasonal period for gold and for gold miners. So I think it's a pretty good setup at the moment. And what you can see on the next chart, this is actually...
Before you go to the next chart,
sure.
I want to ask some questions about this chart. Do you know if this is like monthly or weekly or daily
monthly
prices here? So this is monthly. What was I don't know what the monthly average was for January of 1980 when gold peaked at 850, but it's probably somewhere in the 600s.
Yes,
because it was a pretty quick spike. So that $2,308 inflation adjusted price is actually much higher than that. This is a monthly average. It's probably well over $2,500 when you're talking about a day. And if you're talking about intraday, it might be like $2,800 or over $3,000. And then the other thing I want to comment on is this is inflation adjusted. So you used the CPI to adjust this, right?
Yes.
Yeah. And I look at everything else. If you take a look at the price of real estate from January of 1980 to today, or the stock market, or a whole bunch of different indicators, the CPI or the CPI isn't anywhere close. It's the pre-Ronald Reagan CPI is much, much, much higher than the CPI they have today. But the truth is somewhere in the middle. But I would suggest to people that this $23,000 to maybe $3,000, if you're going to go with the daily price instead of the monthly average, this $2,300 level probably equates to 28, maybe 3,000, something like that. That is using the CPI. So you have to add a percentage on top of that, and I have no idea what that percentage is. But the CPI definitely underestimates inflation, whether it's slightly or whether it's severe. It depends on the areas that you look at in the economy. But I can't find anything that correlates to the CPI. Everything that I look at is above that. So I just want to point out to all of the viewers that your charts and your measurements look great, but they are on the conservative side.
Yeah.
So, yes.
But just a couple of numbers to compare it. 1980, we saw the price of gold at 850. Now currently we're trading at 1800. Now the monetary base in 1980 was 155 billion. Now it's 6 trillion. The M3 money supply in 1980 was 1.4 trillion. Now it's 20 trillion. US government debt in 1980, what would you guess? It was 863 billion. Now it's 28 trillion. So, and the S&P, for example, when gold peaked in 1980, the S&P was at 110. So I think, if you see it on an absolute basis, but especially on a relative basis to money creation or currency creation, to other asset classes, you can see that gold actually is really dirt cheap at current price levels.
Yeah, it is dirt cheap because there's, it's right about, it's above the break even for, there are gold mines that are making a profit these days, but for a whole lot of the mining sector, they're just above making a profit, or they're at a break even situation. And then some mines, were mothballed and haven't even been opened back up yet. You know a lot more about the mining sector than I do, but when it's when it's below the cost of mining, then it is cheaper than dirt.
Yeah.
So let's move on to your next chart here, and you can tell us about this and how it correlates to the last chart and so on.
Well, Mike, I used to work for a bank for a couple of years, and I know how those models work, and especially the very sophisticated models. They work well until they don't. So we're always a bit cautious when it comes to modeling prices. However, last year we did a very basic valuation model for gold, and we said that at the end of this decade, we expect the price of gold at $4,800, which was on a conservative side, because actually it was skewed to the right. So actually significantly higher prices are much more realistic than significantly lower prices. Now this year, we did a gold price model based on implied probability function from the options market. And it is telling us that also here, option market participants do see the probabilities of gold making a new 52-week high, which would be a new all-time high, significantly higher than a new 52-week low. Now, of course, it fits our view from a fundamental, but also from a technical view. So we think that this year we will make new all-time highs in the price of gold. So we will go at 2,100, perhaps even higher. As we've said before, the 2,300 US dollars would be the inflation adjusted all-time high based on the CPI lie that you mentioned previously. So I think this model just confirms that that there's lots of upside actually. And I think it's really important to say that from a risk reward perspective, this is just a tremendous setup that we're seeing. I think, as we've said previously, if I believe that real yields were about to rise significantly, then I would be concerned about my gold position. But highly positive real rates at this stage of our debt cycle, at this stage of our monetary system, they're impossible. This is like, I don't know, Ron Paul becoming the next US president. Unfortunately, it won't happen. So therefore, I think that's a very, very good setup that we're seeing in combination with this, I would say, neutral or even negative sentiment in the market.
Yes, I absolutely agree with you. And I want to point out to everybody here that you're using implied probability of options, and that is basically using the crowd's knowledge. And the crowd's this always works better than some experts predicting things.
Yeah.
It's basically the free market of what the thought is of prediction, basically, of trying to guess what the future is going to be. And typically, the chaos of millions of people giving their opinion is a whole bunch better and much more accurate than just listening to one expert or another. So this is a excellent outcome here, that only 4.9% probability of making a new 52-week low, so a year from when this chart was made, and 44.8. So it's 4.9 to 44.8, almost a 10-to-1 ratio of expectation. And this is by the masses. This isn't by just one or two experts. So excellent.
And they've got skin in the game, so they put their dollars where their mouth is. So I think this is much more important than what, for example, analysts say, because actually gold analysts, and we showed it in the report, they're expecting prices to go sideways or lower over the next couple of years.
Wow. Okay, so why don't you go run us through your conclusion here, and we'll wrap this up.
Sure. So we are seeing that a monetary climate change is happening. So I think there's a number of signs. What we discussed previously, we are seeing the shift from monetary dominance to fiscal dominance. We're seeing that globalization is retreating. We are seeing, and we haven't talked about that yet, we're seeing a structurally weak US dollar going forward. We are seeing that velocity has stabilized and will start to rise going forward, and it will meet this enormous amount of liquidity that was created. We are increasingly seeing Asian countries are starting to export inflation rather than deflation. Then we can talk about demographics that are also turning inflationary now. We see that there's new tasks for monetary policy. In German, we call central bankers Währungshüter, which means safeguards or guardians of price stability or guardians of the currency. But this safeguarding price stability has always been considered the primary objective of an independent central bank. But now nobody really cares about this anymore. So we're seeing, for example, ECB President Christine Lagarde, against all custom, she made a public statement of support for the Green Party's top candidate in the upcoming German federal election. We're seeing central bankers talking increasingly about tackling climate change, about inequality. I don't want to criticize that. It's just an observation that a shift has been happening. Although, from my point of view, nobody really changed the mandates of central banks so far. So we are seeing this return of inflation, and it has a tremendous impact for portfolios. So we see increasing probability of a longer-term inflationary phase. We see, due to the debt situation, that real rates will remain negative for the years to come. In the report, we talk about decentralized cryptocurrencies and also about Bitcoin and how it fits together with gold, actually. And yeah, we come to the conclusion, we continue to see
on that point, the decentralized cryptocurrencies and Bitcoin will not replace physical gold as an investment, but are gaining in importance. I absolutely agree with you. I think that they're complementary.
Yes.
But I think that when the feces hits the fan, when the whole thing is falling apart, the really big money is going to run to what is guaranteed to be safe and what has withstood the test of time for 5,000 years. The really big money isn't going to be going as much into Bitcoin as into gold. And that's the reason the central banks hold gold. The central banks, because of their gold, will be able to start up some game again after everything, when there is the reset They're going to be able to run some scam based on a fractional reserve central banking gold monetary system. Anyway, so get back with what you were saying. I'm sorry I interrupted, but when you hit cryptocurrencies there, I just had to touch on that because I really do believe that the big fireworks are going to be really, right now we've seen big fireworks happen over and over again in cryptocurrencies, but that's all been small investors driving that and just a taste of large investors. I think they're both going to see some big fireworks, but the biggest portion of the institutional currency that's out there, the institutional cash, is going to run toward gold. So, your opinion on that?
Well, there's a very heated debate between the gold camp and the Bitcoin camp, and I think it doesn't make any sense because the discussion should be gold and Bitcoin versus fiat money. So
Yes.
I think there's many similarities between Bitcoin and gold. I think the creators of Bitcoin, they truly understood our monetary system. They truly understood the flaws of inflationist policies. They understood the Austrian School of Economics. So they created Bitcoin as some sort of digital gold with a very high stock to flow ratio, with a low inflation rate that is actually decelerating. So, I'm a free markets guy, and, I don't see where all this criticism comes from. I think competition is good for the consumers. Why shouldn't we see competition in currency markets? And, we've got two funds that actually combine physical gold with Bitcoin, for example. So it's 75% Bitcoin in 75% physical gold stored outside of the banking system, and 25% Bitcoin with an options overlay. So actually, we think that volatility isn't an enemy, that it is actually, you can use it as a friend, and especially in a highly volatile asset class like Bitcoin, you can make use of this enormously high volatility. So we regard gold for stability and Bitcoin and perhaps some other cryptocurrencies for convexity. But, gold has a track record of more than 5,000 years. Bitcoin, a little bit more than a decade. So of course, the volatility of Bitcoin is significantly higher. Of course, the whole infrastructure is not that sophisticated yet, but I'm seeing quite a lot of positive developments. So I think that Bitcoin has really grown up. I think that there's quite a lot of positive things happening. And therefore, I think, we like both. And I once made the comparison, you can drive from A to B in a very solid and safe Volvo SUV or the Tesla, what is it, Model X. You can go there with your family and you will arrive on time and it's safe. But you can also ride a motorcycle, Ducati Panigale with 140 horsepower. You can go also from A to B. Of course, it is much more risky. And once it starts raining or snowing, it's getting more and more dangerous on this motorcycle. But why not have both in your garage and use both sometimes? Yeah. So that this is our view. But I know that this debate between those two camps is very, very heated. I just don't want to join it because I think it doesn't make any sense.
I absolutely agree with you, and that's the reason I own both cryptocurrencies and gold. Your next item in your conclusion is that mining stocks will have the most profitable year in history in 2021. And I want to remind everybody that, investing is a team sport. And the more complex investing gets, the more you need a team. So you need somebody like Ronnie and his staff at Incrementum AG if you're going to go into the leverage that mining stocks can give you. But they are more volatile, and you need to be able to have a higher probability of picking a winner. And you have that when you've got somebody on your team that's analyzing that mining stock for you. So tell us about that, Ron.
Well, last year was terrific for the mining space, and we did like I think 120 company meetings. Unfortunately, most of them virtual meetings with company representatives, and it really seemed sometimes like attending a deep value conference. So we are seeing balance sheets are pristine. So many companies are already in a net cash position, and those that are not already, they will arrive a net cash position in 2021. Most companies continue to have very conservative price estimates at 1,200 to 1,300 to calculate reserves and project economics. So we're seeing free cash flows being prioritized. So we're seeing reinvestment in the business through exploration of capital spending, and we're seeing that companies are returning cash mainly via dividends. So from my point of view, the gold mining industry is at its healthiest shape in decades. But Mike, miners are only finding 20% of annual production at the moment. So their reserves are depleting. So I think going forward, we see quite a lot of M&A activities. We will see more investments, but of course, there's a big time lag from the decision to increase your exploration until you really can harvest the fruits of that by producing more gold from a new mine, for example. So I think at the moment, mining stocks are a tremendous long-term buy, but I think you're on the same page. I think we should never mix it up. Physical gold is really as some sort of insurance, while when you invest in mining stocks, you've got a company risk, you've got a management risk, you've got a political risk. Just have a look at what's happening in Peru or also in Mexico to some degree. You've got geological risk. So it's really something that has to be done well and perhaps via funds, perhaps via our funds. So I think it's really important to say that, you can have, let's say, security or insurance gold, which should be physical gold outside of the banking system, but then you can also see it as a speculation. And then I think mining stocks are a great idea at the moment.
Yes, and I want to point out something that to our listeners that you just mentioned. You mentioned declining discoveries, the new deposits that they're discovering. Did you say they're discovering only 20% of what they're currently mining?
Yes.
Wow, that is a much larger discrepancy than I thought. And that means that when everybody rushes into this and wants it, there's even less available. So that means that precious metals in general are just set up for one of the biggest explosions in financial history. I want to really thank everybody for watching this. I want to thank you, Ronnie, for all of your insights and analysis and the tremendous work that you and the team at Incrementum AG does. And I want to remind everybody, investing is a team sport. So get somebody like Ronnie to help you with your decisions, especially as you go into more complex investments. Buying gold is very easy. Buying a stock, you're not buying gold. You're buying a company and you're buying management. And so you want somebody helping with your decision-making and the guidance. So go to their website at Incrementum AG. Tell us what your website is, Ronnie.
It's incrementum.li. And we've got a special webpage dedicated just to the In Gold We Trust report. It's ingoldwetrust.report. So you can download the full version, 350 pages, but also the compact version, totally free of charge. You don't have to register or sign up for anything. You can just download it totally for free on our webpage.
Okay, I want to thank you so much for this series of interviews. It's been so enlightening. It's just been wonderful. Thank you very much, Ronnie.
Mike, thank you very much. Take care and see you soon. Bye-bye.
Okay, see you later.